The crypto market has been absolutely crashing with no signs of reprieve, largely due to geopolitical uncertainties, the tariff war between the United States, Canada, Mexico, and China. So, what do you do about that? How do you deal with a down market? In today's episode, I cover some strategies that can be useful to you when you make your own decision. My name is Crypto Andy. I'm a crypto trader and enthusiast, and I make educational videos to help educate you. So let's jump right in. There are three main actions that you can take. You can buy. If you think the crypto market's going to reverse, if you think that things are going to turn around, you can make a purchase. You can do nothing. You can sort of close your eyes, put your hand in the sand. You can just, focus on work, focus on your business. You can go on vacation. You can just do nothing. You don't have to trade at all, right? Choice number 3, you can sell. And there's a lot of different ways to sell. And I'm going to elaborate on choice number 3 because that's the one that I think for me is appropriate, but you need to decide for yourself. You can buy if you have the money to buy it and you want to risk more, but the pro of that is you can get really good deals, but the con is you get wiped out even worse because the market is going down. So the first thing that you can do if you think the bull run is over is you can sell everything. You can sell it all and exit completely from the crypto market. So if you had a $20,000 investment, if you got out now, you would get $15,000, and I'm suggesting that you get out completely, and your net loss would be $5,000 of loss. So you keep $15,000. So, sort of give you an example. I got out in profit of Ray at around like 2.25, and right now, so I missed 33% down, right? And I would not have been in profit if I had waited. So I got out of Ray and it went down 33%. So that's how you can think about it. You can think about that you're missing a loss and you're okay with that. So why would you choose this action, right? Are there advantages or disadvantages? Of course, the advantage is tax advantages. If you have a loss of $5,000, then you can write that off on your taxes. So if your taxes are, if you're paying like $6,000, which if you make like 60 grand or above, you're paying at least that much, then you would get pretty much all of your taxes back. And it rolls over into 1 more year forward, I believe. So there is a tax incentive for you to get out, and you can think about, you recover that money because you don't pay any taxes. So that's a really big advantage. So like a con for that is that you miss out on bigger profits because the market turns around, this is a retracement, and you miss out, right? Another pro is that you minimize your downside. If you really think the bull market is over, altcoins lose like 90% of their value. 90% is a tremendous amount, percentage loss. You got absolutely murdered. So if you miss out on that, that's a good thing. But again, if there's a reversal, then you miss out on profits. Maybe there's a reversal, you could have gotten out a better time, also negative. But you pulled the trigger, you made a tough decision, and you can think of it like you're going to get your taxes back. You can think of it like you don't want to bet the farm on this decision, you're overexposed, then maybe selling it all would be appropriate for you. The second thing that you can do is you can DCA out in stable coins. So DCA stands for dollar cost average out. A lot of people dollar cost average in. They buy, every month. They want a total of 10,000. So a total of 15,000. And every month for 5 months, they divided it by 5, and that's how much they put in every month. You can do the same thing in reverse. You can DCA out, scaling out. This is a very popular thing to do for traders. And this is the one that I'm going to start to do. Each month you sell 5% of altcoins. So if you have $15,000, 5% equals to $750. And in 20 months, you'd be out completely. So what is the pro of this? The pro of this situation is that you're still in the game. You're essentially building a cash position in stable coins. It's not cash, it's stable coins. But you can reinvest that if you see a good time to come back into it. So for example, if there's a lot of like resistance here for radium and it gets above, say it gets above like the $3 and $20 mark, you're like, okay, at this level, I feel like the price is definitely going to go up because it's broken through some major resistance, and now I'm back in, right? You have a reason to get back in. You built a cash position, you can do that. So you're still in the game, but the con of that is that you don't get out fast enough. If it doesn't go that way, then you could have gone out faster, right? And DCAing is inherently slower than selling at all, but you can get back in. If you get back in and then it turns down again, you lose your reinvestment. So you really have to decide that you're going to DCA out and stay out. That would be better unless you're absolutely certain of what you're doing. And a lot of people would just be better off just scaling out totally, taking profits totally, minimizing loss totally. Again, there are tax advantages to this, but you could, the problem with DCA is that there's just like a pile of stable coins there that you can just so easily reinvest. You got to be disciplined to DCA out, but I think DCA out makes more sense because one of the tenets of trading is minimizing your loss. And when you DCA, you minimize your loss so that if you had to take 100% later, then you have a small amount, right? At the 5% intervals, 20% would be 4 months from now, January, February. So March, end of March, April, May, June. So by June, you would be 20% out of your total holding. And if you had to, immediately take everything out, then you're in a better position to do that. You can go a little more aggressive if you want at 10%. By June of this year, the market is still way down and there hasn't been a catalyst, then you're going to be glad you DCA'd out. So DCAing makes a lot of sense. All right, the third thing you can do is that you can swap into Bitcoin, swap into BTC. You don't have to get into stable coins. You can just swap whatever amount you want at 5% or total, like we discussed. You can choose one of those two exit strategies and you can swap into BTC and you're like, okay, I'm happy with BTC. BTC has a big future. I think BTC will get to $1 million by 2040. I can't lose because I think that ultimately whatever loss I take, Bitcoin will increase in value and I'll be fine long term. A lot of people take a long-term view on BTC, want generational wealth. The altcoins are tougher, but they didn't fare as well. So they just swap into BTC. This is the crypto money, right? This is like I have an IRA, I have stocks and bonds, I have a house, I have gold coins. And this is my crypto allocation of my portfolio. And I'm not going to trade it for something else, right? I don't want money. I don't want dirty fiat. I'm happy with Bitcoin because I know that long term I'll succeed. So this is for kind of like the diehard crypto people, but it does make sense on the long term perspective. If you think in 10 years from now, in 2035, that Bitcoin will be at a far higher valuations, $500,000, $1 million, then any amount of money you put into it now is good because you think that way. You have a long-term thinker. So swapping into BTC and keeping a total amount of your portfolio in Bitcoin does make a lot of sense if you have the patience for that.